HP Computers, which is the 13th largest position in Warren Buffett's Berkshire Hathaway portfolio, just announced layoffs of up to 12% of their workforce in a bid to increase their profitability over time. And that increase in profitability could potentially give you a 13% equity yielding company by the end of these restructurings. And so that's what I'm going to cover in this video. So guys, as you smash that like button, let me run the intro. What's up, guys? And let's jump right into this one because this is a very interesting one. So as you can imagine, the Silicon Valley cuts continue. And so we've seen Amazon announce cuts, Meta has announced cuts. I think Alphabet is expected to announce cuts soon. And now we're seeing HP recently announce cuts of up to 12% of their jobs by the end of fiscal year 2025. And so just a little bit more detail, Reuters did report that they expect to cut up to 6,000 jobs by the end of fiscal year 2025, which represents approximately 12% of their global workforce. And I'm saying that as corporate budgets are being finalized right now, and we expect tightening across the economy, we could expect more of these announcements as time goes on. And so HP said that they also forecast a lower than expected profit for the first quarter of fiscal year 2023, as it expects softness in both consumer and commercial demand. And so they're saying that many of the recent challenges that they saw in fiscal year 2022 are likely to continue into fiscal year 2023. And so they have to pivot their operations to meet those challenges. And this is what I mean about this being one of Warren Buffett's largest positions. This is number 13 on his list. It's higher than Citigroup, Kroger, and Paramount. And they recently reported earnings, and you can see that there is a serious weakness in consumer spending showing up on their financial statements. So you can see that the notebooks are down 4%, but consumer supplies are down 11%. And so of course, overall revenues are down 1%, but if this weakness continues, you could see serious deterioration of revenue in fiscal year 2023. And this is how I'm forecasting out fiscal year 2023. This is a model that you can get access to at that lower tier of the Patreons. And so all the Patreons that get access to all of my models at that lower tier for only $5 a month, you can get access to every single model, which includes Alibaba and etc., all the chip makers, everything. And so the way that I'm forecasting out HP's fiscal year 2023 is I'm forecasting revenues to decline by 5%, so much lower than the almost 1% in fiscal year 2022. And in fiscal year 2024, I'm expecting revenues to stay stagnant at that lower amount of basically a 0% revenue growth rate. And then thereafter, I'm expecting a 3% revenue growth rate. So just in line with where I expect inflation to be subsequent to 2025. And when you look at the gross profit margins, I'm really penalizing them in fiscal year 2023. So I've really brought down the gross margins from where they fell in this past year. So they just reported gross margins at approximately 20%. I'm taking 2 turns off of that. And so I'm forecasting at 18%. So you could say that I'm pessimistic here. And then I'm only bringing that up to 18.5% in fiscal year 2025. So once again, potentially being very pessimistic on this name, but as I'll show you with the valuation, it still reflects a pretty decent yield of 13% on an equity yield basis. And so what do they mean about their headcount cuts? Well, you can see that they expect a gross annualized run rate savings of approximately $1.4 billion a year. And so they expect 40% of that to be realized in fiscal year 2023. But of course, that'll be more than offset by restructuring cost charges. So you really won't see this flow to the bottom line until fiscal year 2024. And so you're seeing that they're saying that they're going to have restructuring and other charges of approximately $1 billion. And so 800 million of that is expected to be non-cash. That's going to offset the 40% of total cost savings, which amounts to, I think, around $500 or $600 million in fiscal year 2023. Now, this gives you a timeline of when you're going to start seeing those cost savings as you model this out. So notice that they're saying that you're going to get a little bit more than 40% in fiscal year 2023. You're going to get approximately 30% of those 1.4 billion run rate cost savings in fiscal year 2024, and then you're going to get the other approximate 30% in fiscal year 2025. So as you build this out, you're going to have to run rate those accordingly, and that's how I'm doing it in the model, which I'm going to show you in a second. But what does this mean overall? Well, you can see that they're forecasting around 2.2 to 2.6 dollars per share of EPS in fiscal year 2023, but notice that they're giving you their non-GAAP diluted EPS of $3.20 to $3.60. Now, of course, you're not going to get that in fiscal year 2023, but this is a good run rate to start with modeling this out for fiscal year 2024. And so you can see at the bottom right there that I was right when I said that the run rate cost savings in fiscal year 2023 will be around $560 million. But of course, they're going to have GAAP only charges of approximately $1.2 billion. And so this is less than half of the one-time charges that they're expecting to incur in fiscal year 2023. So expect fiscal year 2023 to be a little bit of a wash, but they give you their GAAP diluted EPS numbers of 2.2 to 2.6. So you know where they're going to fall in this year. But the real question is, where are they going to fall subsequent to that? Well, you can see this is how I'm forecasting it out. Notice the operating profit margins. It was 8.9% in fiscal year 2021. It was 7.4% in fiscal year 2022, and it's dropping to 5.8% in my opinion in fiscal year 2023, but that's because I brought the gross profit margins down by 2 turns. It could be easily 7.4%, but I just don't think they're going to hit that. So in fiscal year 2024, you see it recover a little bit as they generate some of that cost savings. So it goes up to 7.4%. And then in fiscal year 2025, when they realize all of it, you're going to see the operating profit margins increase to approximately 8.9% or 9%. And so this is how I'm expecting the numbers to fall out. But you guys let me know what you think the numbers are going to look like. And if you don't have any sort of opinion, at least drop a meow in the chat to help with the algorithm. Now, the question is, where do I see this company valued at? Well, now before I go into the valuation, I just want to remind you guys that approximately 80% of the watch time on this channel is coming from people that are not subscribed. So if you have the opportunity, hit that red subscribe button. Now let's go right into the valuation. You can see that I'm valuing the company at approximately $38 per share. So compared to their current share price of approximately $30 per share, it's not that much of a value, but beyond 2023, this is a $4 per share equity yield stock. And so if you take that $4 and you divide by 30, I believe that it reflects an approximate long-term yield of 13%. So it's something really to consider in your sort of dividend portfolio. Now, you guys let me know how sustainable you think that is. Now, let's take a look at the cash flow to see what they do with the cash that they're generating. Well, if you notice here, share buybacks in fiscal year 2022 were only $750 million, but I expect the company to continue to resume returning capital to shareholders beyond 2023. So this is really a dividend payer plus a massive share buyback company. And so you're going to get a lot of capital returned to you, in my opinion. You guys let me know what you think that they're going to do in the future. But of course, this is only one potential opportunity that Warren Buffett is invested in this environment. Another opportunity that Warren Buffett is invested in is that sort of Activision workout type opportunity where Microsoft is acquiring Activision. And so Warren Buffett acquired shares of Activision in hopes that they get acquired from Microsoft at a higher price. I call into question that deal, but I ultimately do believe that the deal gets done. If you want to know exactly what's happening and why the shares are being priced 30% lower than the transaction price, I broke that whole thing down in this video right here.